So good afternoon, everyone. Welcome to the class on investment management. So we have discussed the passive management strategy in the last class. We are discussing about how mutual fund works. In that, we have discussed what is meant by passive portfolio management strategy. So you know actively how you can manage a portfolio. Managing portfolio with an by an retail investor is not an easy task. So we need to understand how it is moving, how the market is responding with the kind of news which we are witnessing with the period of time. And based upon that news, based upon the way the economic scenario get changes, based upon that we need to keep changing our stocks in the portfolio, or certain times we need to see beyond the stock market for our investment part. So basically there are a lot of segments on which we can do investment. Along with stock market investment, we can go and do investment in debt market, or we can go for a gold or other commodities also for doing investment. Because I hope you must be aware about, when we talk about the coefficient of correlation of a stock with the commodity is normally negative. So that way, putting money in commodities or debt market would be very good source of hedging strategies. Hedging, when we talk about hedging, what is hedging? Hedging is basically, it is a trading strategy. When we talk about hedging, hedging is basically a trading strategy where the objective of working on hedging is to minimize the risk on the investment. So every fund manager, when they work for trading in the market, they work with an objective to minimize the risk. Their objective is to work on risk minimization strategy. Okay, so we believe that the individuals who trade in the market, they are risk averse investors. So as a risk averse investor, we always want to maximize our return with a minimum possible risk, and that's why we while doing investment in the market, we work on a lot of risk return trade off. So when we talk about risk return trade off, we talk about a sharp ratio, we talk about sharp ratio, we talk about trainer ratio, we talk about trainer ratio, we talk about Jensen alpha. So these parameters, either it is sharp ratio, or either it's a trainer ratio, or either it is a Jensen alpha. The purpose of choosing them for the investment strategy is to maximize our return with a minimum possible risk. The difference between sharp ratio and trainer ratio, when we talk about sharp ratio and trainer ratio, the difference between them being would be, the sharp ratio talks about the excess return with respect to standard deviation, while trainer ratio talks about the excess return with respect to the beta of the stock. So sharp ratio basically talks about the unsystematic risk, and the trainer ratio basically talks about the systematic risk on our investment. So so that framework we can keep in our mind as an investor. When we see an investor who trade in the market, many investors are not basically a day trader. They are basically someone who go for investment strategy. So whenever we talk about investment strategy, whenever we talk about an investor who talk about an investment strategy, so the purpose of doing investment in the stock market is to invest for a longer time period. So whenever we go for investment in the market for longer time period, then possibly what we are looking for in a portfolio. When we create a portfolio, what we are looking basically is to create a portfolio which where the constitutes which are there in the portfolio, they should be negatively correlated. So the purpose of having negatively correlated is to get a desired expected return, what we are looking for. So whenever we look for a desired expected return, so certain time we try to bring different constitute in our portfolio which are negatively correlated, and this form of trading strategy is called hedging. Hedging basically come from the term which means risk minimization. So whenever we try to minimize the risk, the possibly the returns downside, if you try to minimize, then automatically your upside will also get minimized. Okay, if instead of that, if you put your money in one stock, so then definitely the graph of your returns would be very volatile. You may end up in getting very high return or very low return, so there would be a lot of fluctuations or volatility in the values of your investment. But if when you go for hedging, then you have restricted the movement of the stock. So there is a certain minimum return what we are expecting, and that on that objective only this hedging would be done. So you know that very important rule in finance, that is more risk, more return. So with hedging, we try to minimize our risk. So if we try to minimize our risk, so then automatically our return will also get minimized. So I hope you are getting that perspective in your mind. Along with hedging, there are other terms which you can remember. That is called speculation. There is the other term which we can remember, that is called speculation. So when we talk about speculation, speculation is works on the perspective that more risk, more return. Speculation basically works on this objective called more risk, more return. So in speculation, along with investment in stock market, we do investment in derivatives market. So speculation, they are speculation is all about rumor, the rift, the kind of the what you say news about certain stocks which are we are getting, not public news. There are a lot of rumors which we are getting when we are observing the market. Normally, speculation is done by day trader. Investment or hedging is done for in long-term trader, while speculation is done for day trader. So they go with rumor every day. Like when you watch news in the morning from 9 to 3:30 p.m. So there are lot of information, lot of news which are coming. Certain news are real, certain news can be factual also. So which are time bound news. So we may run behind those news, and we try to take decisions in the market based upon those kind of news without validating how much that news is correct. So there are lot of investors who go for speculative activities in the market. So along with stock market, uh, we have stock market, and along with stock market, we have derivative market. So we can go for derivatives also for doing investment. And when we choose derivatives for doing investment, I hope you have heard of derivatives. So when we go for derivatives, then in case of derivative, we don't have to pay 100% of money upfront. We just need to pay initial margin, and by paying the initial margin, we get an obligation on the contract, and then possibly we can make the payment later on. And in case of derivative, the settlement, what happens in derivative is a cash settlement. So and then by going through cash settlement, we end up in getting more profit or more losses. That is basically called a speculation. So if you see your question paper also, so the difference has came. What is the difference between hedging and speculation? So so the differences came in some year. The difference between hedging and speculation. You can see this. Question number two, part B. Distinguish between investment and speculation. So investment is something which we go for long-term origin. When we do investment, our objective is to invest our money for longer time period. While when we talk of speculation, in the case of speculation, the time limit is not defined. The objective of doing speculation is to earn more risk and is to earn more return by taking more risk. That is the way how we work on speculation. So in derivatives, when we talk about derivatives, in derivative forward contracts are not allowed to trade over our market. So when we think of derivatives, we invest our money in futures and options. So when we invest our money in futures and options, so they gives a lot of room of speculation for us. And in case of futures and options, case of derivative, we have equity derivative instrument, we have currency derivative instrument, we have commodity derivative instruments, we have interest rate derivative instrument. So when we look for derivatives of futures and options, so we get a lot of flexibility of doing investment. We can invest in a portfolio if we are more interested for portfolio. So in derivatives, we have stock futures, we have index future, we have stock options, we have index options. So like if you want to invest in Nifty, so you have Nifty futures, or you have Nifty options on which we can invest. So derivatives gives you lot of room of going through the speculation, and thereby we end up in getting more return by taking more risk. Or it can be the scenario we end up in losing lot of money because we took lot of risk on the market. So again, so those who invest their monies on derivative market, they should be knowledge enough to understand the risk of going through investment in derivative market. And those who go for speculation, they need to understand what kind of news they can believe whenever they go for lot of day trading activities. So they are brokerage houses. If you go for a day trading with the brokerage houses, you don't have to pay 100% of money. They'll give you a ratio, 1:30 ratio, 1:50 ratio, depends upon the advanced brokerage, how much you have submitted to the brokerage house. So the advanced brokerage which you have submitted, based upon that, you get a leverage. So based upon how much money in your account, so in your trading account, so in your trading account, how much money you have deposited. So using that money as a what you say, as a template, or using that money as a benchmark, ratios are given. 1:20 means 20 times of that, or 50 times of that is given by brokerage house, which you need to trade within the day. So you need to square off everything within the day. So you cannot continue that transactions. So you can do short selling, you can sell first, buy later on, you can buy first, sell later on, but everything you need to square off within the day. So that is called day trading. So not even in derivative market, even in stock market also, when we look for investment, if your objective is to go for day trading, so definitely your brokerage house will give you that flexibility of going through a day trading or speculative activity, but everything need to square off within the day. So then there's a possibility of getting a lot of losses, and you may end up in getting a lot of profit. So that is what speculation is all about. Going further, you have understood hedging, you have understood speculation, and the third thing what you need to understand is called arbitration. The third thing we need to understand is the arbitration. So these three terms are very important. What is hedging? What is speculation? What is arbitration? So arbitration is all about earning. Arbitration is all about earning risk-free profit. Arbitration is all about earning a risk-free profit. So in arbitration, when we talk about arbitration, arbitration happens because of demand and supply gap. So because of demand and supply gap, so because of demand supply gap between the two markets, the same commodities, if we're trading at two different price, then we can take an advantage of that and earn risk-free profit, which is called as arbitration. So basically, like suppose there's a stock. Suppose this is not possible in real world. I'm just telling you. So every stocks trade in Bombay Stock Exchange and National Stock Exchange. Suppose there's a company called Reliance Industry. The stock is trading in NSE at 1007, or maybe in BSE it is trading at 1007.5. So what you will do, you will start buying all the stock from NSE, and then you start selling all the stock in BSE. So if you buy billions, if you buy in bulk, so that is called block trading or high frequency trading or algorithmic trading. So if you buy a lot of stocks in bulk from NSE and you try to dump all the stocks on BSE, so thereby on every stock you will earn zero point 0.5 or 50 paisa profit on every stock. And imagine if you had traded in millions, then your profit would be half of million. Okay, so and half of million is very big figure. Imagine if you're done trading billions, so your profit would be half of billion. So that is called arbitration. In real market, arbitration actually does not exist because because we normally work on computer based trading environment. We are working on computer based trading environment. If they, because then in case if there is any possibility of arbitration also, the traders or the brokerage houses, they already have the software which works on algorithmic trading. The moment they identify this difference in price of same stock in two different market, automatically they start engaging in block trading between these two market. The software itself started involving in block trading between the two different market, and within the couple of seconds for which this difference arise, the software take advantage of the difference, and then normal individuals cannot trade with such a speed, even then if they could able to identify this. First of all, identifying this is very difficult. Okay, the first of all, identifying this is very difficult. Even then, if you identify the difference also for the equity value in two different markets, if you identify the difference also, then undergoing the predictions is not easy for us. So as a normal individuals, you can, what we can do, we can, if we try to trade in hundreds or thousand shares also, then also we could not able to recover profit, because there are a lot of, we need to pay security transaction tax, we need to pay short term long term capital gain tax. So the taxes and other adjustments, if we start do, if we do also, once we get the profit also, little bit of profit on one stock, so that would be in paisa, for a stock profit would be in paisa. And then if you start deducting your taxes and all, then you end up in getting no profit, no loss. So that works in such cases where the volume is there, where lot of stocks is being bought and sold, then possibly that situation can be worked on. Otherwise, this is not an easy task to do. Clear, everyone? Anyone have any doubt? So whenever you open the market, whenever we open the market, we you see many times this, this is very common. We see many times this difference. We can observe the difference very easily. Like if I open and show you, there are a lot of scenarios. Like if I go to money control, so anything like a course. So I clicked on Yes Bank. Simply, the Yes Bank was in front. So if I go and check it price, you can see this. In BSC, Yes Bank is 14.65. In NSC, Yes Bank is at 14.70. So normally, you can find these differences. Normally, when we when we see the market, this is very common. For a same stock, you can see the two different value over BSE and NSE. But doing actual trading by buying in BSE, you start buying in BSE and then you start, if you try to sell in NSE, so then that you could not able to work on this difference as a retail investor. Those who are having lot of software, the brokerage houses and all who have account in both BSE and NSE, to trade on NSE, you need to you need to have an account. You need to open a trading account. You can see you need to open a trading account with NSE to trade on BSE. You need to have a trading account with BSE. Then when you're doing on them, trading on them every day, we need to pay taxes and all based upon the volume of trading what we do. So purposefully, even then, we can see the difference over the same stock. This stock is Yes Bank. I hope you heard of the history of Yes Bank. What is happening with Yes Bank? So the when you talk about Yes Bank, you have seen the share price of Yes Bank. So this is the Yes Bank. So you can see Yes Bank today. Yes Bank is at 14 rupees. Today Yes Bank is at 14 rupees, and see this. So once upon a time, so in January, and this is December, no? So in January, Yes Bank was at 41 rupees. Okay, and in March it went to 64, 65 rupees, and today it is trading at 14 rupees. So you can see how much volatility has happened on Yes Bank. So if you see, this is 1 year. If I show you last year data of Yes Bank yesterday last year was trading at 270 rupees. Imagine last year if you had bought, suppose somebody for the investment purpose, of he or she, if you would have bought Yes Bank shares, you would have got this share for 270 rupees, and today that share is trading at 14 rupees. Imagine how much losses you would be getting per share. I hope you'd have heard about what has happened in Yes Bank, the problem what the Yes Bank has faced, and the reason why they reached a kind of bankruptcy kind of situation. So from bankruptcy, government somehow saved Yes Bank from the bankruptcy, and now Yes Bank today is trading at 14 rupees. The same company which last year was trading at around 270, 280 rupees. So you can see this. So December 2019. So last year, today is like December. We have entered to December. So November, December, it was trading around 66, 67. And so 1 year return, if you see, you can imagine from 66, 67, it went to 14 rupees. So you can see that 5 year before, if I see the price of Yes Bank, so 5 year before Yes Bank was trading at, so 2017-18, it was trading at 300 rupees. Imagine from 300 rupees, it reached to 14 rupees. You can see what is happening in the real market. So what is the reality you can see with that? So the bank, Yes Bank. So all has happened in Yes Bank. So what was the problem? Recently, RBI is coming with an recommendation where RBI want private individuals, like private houses like Reliance, Ambani's, Tata's, where their government is considering to give them banking license. Imagine if Ambani's and Birlas and all, if they'll get banking license, then the problem what has happened in Yes Bank, it can become more prominent to the in a country like India, where maximum people look for saving deposits or FDs and all as a best source of investment. So hardly 5 or 6% of Indians, they do investment in stock market. Majority of Indians, when they look for investment in the market, so or when they looking for return, they look for return in traditional investment product like post office or bank or FDs, PPF, National Saving Certificate. And imagine if banks start defaulting and all, then what will happen to the future of the millions of Indian people who look for traditional investment products or risk-free investment product as the majority form of doing investment for the long-term horizon. So you can, I hope you can understand the kind of perspective what we are looking here. Okay, so anyone have any doubt, any question you want to ask? So, so investing our money in one stock is never an ideal strategy because we should not look for one avenue to invest our money. So that perspective we need to always keep in our mind. Imagine if somebody had invested on Yes Bank only all his money, then what would have happened to the to the value of that investment? You can easily understand. So instead of putting money in one stock, we can look for multiple stocks for the investment purpose, because there is a form of risk which is systematic risk or market risk which we can never minimize. But yeah, there are unsystematic risks which we can minimize by creating a portfolio. So either we work on active portfolio strategy or we work on passive portfolio strategy. We need to understand. We need to keep an eye on what is happening in the market, and thereby at the same time we need to also be aware about the returns what we are getting also. So even then if he or she, if you are looking for investment in mutual funds also. So mutual funds, after all, when we talk about mutual funds after all they track the market. So the value what the mutual fund get derived, which is called NAV, net asset value. So the value what the mutual fund have, which we call as net asset value, this NAV of the mutual fund, it keeps changing depending upon the performance shown by the stocks within the portfolio in the mutual fund. Okay, so we need to keep an eye. We need to rebalancing our investment at a certain time. If we feel that yeah, our mutual fund is not working the way we have expected, then we should replace the existing mutual fund with the new mutual fund. Okay, so that can always be done. So it's not like when we do investment in mutual fund, it's not like we invest our money in mutual fund and then we can sleep. So even then we have done investment in mutual fund. Even then, after that also keeping an eye on the return, like keeping an eye on what is happening with the mutual fund, how much it is going up, how much it is going down. All that is also very important. So that is also important to see the to understand what is happening with the market, because after all mutual funds are subject to market risk. And again, and because they're subject to market risk, after all they are invested on the stocks which are trading over the stock market. So if altogether if the economy is not doing well, so no matter where whichever stocks or whichever mathematical logic we have used to create a portfolio, it may or may not will work. So we need to understand that part. Mutual funds, the and stocks. If you talk about the taxation part, the when we talk about mutual funds or stocks, that if you talk about taxation part, that that taxation means when we are selling them. So if you sell a stock or if you sell a mutual fund, and if you are getting a gain, so that is called capital gain. And whatever the gain we get, we need to pay some taxes on this gain. So it can be depending upon the time period of investment, it can be considered as short term or long term. So there's no long term capital gain tax. So but there's short term capital gain tax. So the time period would be considered here, that is called as 1 year. So if you have done investment in mutual fund for more than 1 year, then the capital gain what we get, that capital gain will come under long term capital gain tax. and that is zero. So after 1 year, if we have sold any mutual fund and if we get a gain on that, then no tax we need to pay on that. But if we had done investment in mutual fund for a shorter time period, less than 1 year, then possibly we need to pay capital gain tax on that. The like that way, like if we invest in gold, like the same way if we have investment in gold, then for the gold is a commodity. So for the gold, the period of capital gain is 3 year. For the gold, the period of capital gain is 3 year. So if we sell the gold what we have bought less than 3 year, then we need to pay short term capital gain tax. While if we sell after 3 years, then we need to pay long term capital gain tax. So in case of gold, if we invest our money in gold, because we know that gold is negatively correlated with the stock market, because gold is negatively correlated with the stock market. So if I do investment in gold, if I invest my money in gold, so if in case if the stock market is not doing well, then my investment on gold will save me from the downturn of the stock market movement. So gold is always considered as a safe haven for doing investment in the market. So the gold can be always be considered for investment purpose. But in case if we have done investment in gold and our objective is not consumption, our objective of doing investment in gold was the investment purpose only. So for the investment purpose only, if we are looking to invest our money in gold, then the best way to invest our money in gold is the gold ETF. The best money to invest our money in gold is to invest in gold ETF. So ETF basically means exchange traded fund. So in gold ETF, whatever money we give to the mutual fund company on behalf of us to do investment on the gold, the mutual fund company will buy that many gram of gold on behalf of us, and then in the actual way how the gold is performing in the real market, the same way the value of the gold ETF got fluctuated in that way. And the advantage what we get if we invest in gold ETF, the advantage we get is the capital gain tax calculation. So for because a gold ETF is considered as an investment product, so the period of short term and long term capital gain tax in case of gold ETF would be 1 year. So that advantage we'll get if we go for investment in the gold ETF. So that advantage as an investor we will get. So whenever we see gold ETF as very good investment product, so we know that we need to always balance our portfolio. We need to always look for hedging strategies in the market. So in that case, if the objective on gold is not to go for long term or not to go for get the physical delivery of gold, we are simply looking for gold for the investment purpose, or we are simply looking for the gold as an avenue which should give us some value in the future when we sell it. So why to handle the discrepancy of having the physical gold, and then taking the risk of storage, and then when we sell it, then the lot of taxes and other adjustments would be happen. So instead of doing all that, we can simply invest in dematerialized gold, which is a gold ETF. That is again very good source of investment. As an investor, we can always have a very good source of investment. So like if you type gold ETF, if you type gold ETF, you can read about gold ETF. You can, whenever you get time, read about gold ETF. What is gold ETF? So gold-backed exchange-traded fund and similar product have flourished since the introduction in 2003. So gold ETF was introduced in market in 2003, and it's from the time being this was introduced. From that time, it has always attracted all form of investors. Okay, so recently gold has become globally accepted as a strategic asset amid a high risk and low return environment, spurring investment demand and expansion of the gold ETF market. The increased quantity, size, and location of gold ETF have provided a easier and more efficient access for the investment or for the investor to allow them to use a general advantage of gold. So that way the gold ETF always a very good source of investment for you. So if you want to know more about them, you can Google it and try to get more information about them whenever whenever you are interested. So instead of having a physical gold, if you are not someone, there are many people who put gold all over their body and home. So if you are not someone, you are someone who invest their money in gold for getting a return, because gold always give you very good return in long term origin. So then possibly you can look for the gold ETF for doing investment for them, and that way it would be very advantageous for you in the long term origin. So you get tax advantage, capital gain tax. You do not get any VAT or security transaction tax or value added tax. Okay, there's no entry or exit load if you try to invest in gold ETF. Okay, less market risk. So no, gold always give you very good return. You will not find much volatility in the movement of the gold. So if you think of investing gold for the long term origin, then it's always advantageous for you. So that factor is always there for you. So if you're not interested to have in physical gold, so this is something which we call as gold ETF. That is always a good source of investment for you. So I hope you understood the different forms of tradings in the market. Possibly when we talk about trading in the market, we can talk about short-term trading, or we can talk about long-term trading. Normally, speculative activities or speculations are involved in short-term trading, while if you go for long-term trading, then we are someone who are looking for hedging, or we are working on developing an active investment strategy. So the best tool which help us when we go for long-term investment is the mutual funds. So either actively or passively, or using both of them together, we can try to create a portfolio where some part of money we can put our money in mutual funds, some part of money we can put ourselves. So you can do both active and passive together, because normal individuals are not allowed to trade in money market instruments, because normal individuals are not allowed to trade in money market instruments, or normal individuals cannot trade on index instrument like Nifty, or maybe Nifty, or Sensex. So through mutual funds, what you can do, through mutual funds, I can invest in mutual funds. I can invest in index fund. So in mutual funds, I can invest in index funds. In mutual By taking the help of mutual fund, I can invest in gold ETF. So by taking the help of mutual fund, I can invest in money market instruments. So these money market instruments, gold ETF or index funds. So these products I can invest through mutual funds, and remaining the stocks I can create by myself. Some form of portfolio I can create by myself. If that also if I can't do, I can choose any mutual fund which overall invest the money, like HDFC Top 200 fund. So HDFC Top 200 fund will invest your money in the top 200 stocks which are trading in the market. So if you choose this kinds of equity diversified fund, if you choose some form of equity diversified fund like HDFC Top 200 and all, so thereby what will happen, you will get an exposure of overall market. So if you invest in equity diversified fund, so you get a complete exposure of equity. If you invest your money in money market funds, so you get an exposure of short-term debt instruments or liquid product. Okay, so if you invest your money in gold, so you gold ETF, you get an exposure of commodity. If you invest your money in index fund, so you get an exposure of a portfolio. You get an exposure of a portfolio which have no unsystematic risk. So thereby what is happening. So thereby, if you create a portfolio in this manner, so thereby what will happen, it will give you an overall balanced investment strategy for you, and thereby it will always make sure that you always get a very good return in the future, and you can save yourself also for taxation part also. So if for taxation part, if we are looking for section 80C and all, we can invest our money in ELSS, equity linked savings scheme. So they are basically close ended mutual fund. ELSS is basically, it is a close ended mutual fund. Our money will get locked for 3 years, but we get the section 80C advantage of income tax act. So that also can be done. So mutual fund altogether is the complete solution of all the investment need what we can have in the market. So anyone, any question, any doubt you have, anything you want to ask me before I end the class? I hope you have understood.